Let's get real. Investing isn't a secret club. It's not reserved for people in suits or those with a finance degree. The world of investing is open to anyone who's willing to take the first step and learn. It's for anyone willing to learn the basics. You don't need to be a math whiz or have a background in economics. All you need is curiosity and a willingness to grow. If you want your money to work for you, you need to understand the language of investing. Just like learning a new language opens doors to new cultures, learning investment terms opens doors to new opportunities. Think of it like learning to cook. At first, the terms are confusing, but once you know them, you can create something amazing. The more you practice, the more natural it feels, and soon you'll be mixing up your own financial recipes. These words, like P/E ratio or volatility, aren't meant to scare you. They're just tools, like measuring cups or spatulas in the kitchen. Once you know how to use them, you'll see they're here to help, not hinder. The more you know, the more confident you'll be making decisions for your future. Confidence comes from understanding, and understanding comes from learning the basics, one step at a time. This isn't about becoming a Wall Street genius overnight. It's about taking small, steady steps that add up over time. It's about building a foundation so you can make smart choices for yourself and your family. Every bit of knowledge you gain is a brick in that foundation. Knowledge is power, and in finance it protects you from bad deals and helps you spot good opportunities. It gives you the confidence to say no when something doesn't feel right, and the insight to say yes when it does. Don't walk into investing blindfolded, learn the terms, and you'll see the path clearly. You'll be able to navigate the world of finance with your eyes wide open. Promise yourself you'll stop being afraid of what you don't know. Replace fear with curiosity, and watch how your confidence grows. Learn the language of money. You deserve to be fluent. The more you practice, the more empowered you'll feel in every financial decision. This is about your dreams, your goals, and your security. It's about giving yourself the tools to build the life you want. Let's get started and make investing simple. Your journey to financial freedom begins with understanding the language, so let's take that first step together. Let's break it down. When you hear the word share, think of it as owning a small piece of a company. Each share represents a tiny fraction of the business, and by owning one, you become a part owner, no matter how small your stake. It's a lot like having a slice of pizza. Your share is your piece of the whole pie. If the company does well and grows, your slice becomes more valuable, and so does your investment. The better the company performs, the more your share is worth. Some companies even pay you a bonus from their profits, called a dividend. It's like getting a little thank you for being an owner, usually paid out in cash or sometimes more shares. But not all companies pay dividends. Some choose to reinvest their profits back into the business to grow even faster, hoping to increase their value over time. Market capitalization, or market cap, is simply the total value of all the company's shares combined. It's a quick way to see how big a company is in the market. Big companies like Apple have massive market caps, making them some of the most valuable businesses in the world. Smaller companies, on the other hand, might have more room to grow, but they can also be riskier and more unpredictable. When you're looking at a company to invest in, ask yourself a few key questions. Do I want to own a slice of this business? Does it pay dividends, or is it focused on growth? How big is the company compared to others? Large-cap, dividend-paying companies are usually more stable and can provide steady returns, making them popular with cautious investors. Small-cap companies might offer more potential for rapid growth, but they also come with higher risks and more ups and downs. By asking these questions, you're already thinking like an investor, ready to make smarter decisions about where to put your money. How do you know if a stock is a good deal? It's not just about the price tag you see on your screen. To really judge a stock's value, you need to dig a little deeper and look at some key numbers that tell the real story. One of the most important numbers is the P/E ratio, price divided by earnings. This simple formula gives you a snapshot of how much investors are willing to pay for each dollar a company earns. A high P/E means people expect big growth. They're betting the company will earn a lot more in the future, so they're willing to pay a premium now. A low P/E could mean a bargain, but it might also be a warning sign that investors don't see much potential. Sometimes it's a sign the company is struggling or facing challenges. That's why it's smart to compare P/E ratios within the same industry for context. What's considered high or low can vary a lot between sectors like tech and retail. Next, let's talk about the bid-ask spread. This is the tiny gap between what buyers want to pay and what sellers want to get. It's a detail many beginners overlook, but it matters. For big, popular stocks, this spread is tiny, just pennies, because there are lots of buyers and sellers trading all the time. For smaller or less traded stocks, the spread can be much wider, sometimes several cents or even dollars, which means it costs you more to buy or sell. The spread is a hidden cost that can eat into your profits, especially if you trade often or in large amounts. Over time, these small differences add up. That's why it's wise to stick with well-known, highly traded companies when you're starting out. You'll avoid big spreads and keep your costs low. Understanding these numbers, PE ratio and bid-ask spread, helps you make smarter, more cost-effective investments. It's about seeing the full picture, not just the headline price. Don't ignore the details, they add up over time and can make a real difference in your returns. Mastering these basics is how you become a savvy, confident investor ready to make smart moves in the market. Two key traits of any investment: liquidity and volatility. Liquidity means you can sell quickly at a fair price, like cash or big company stocks. Illiquid assets, like real estate or obscure stocks, are harder to sell fast and may force you to take a loss. For beginners, stick with liquid investments for flexibility. Volatility is how much a stock's price jumps around. Low volatility stocks are steady. High volatility ones can swing wildly. High volatility can mean big gains or big losses. Know your risk tolerance. If big drops make you panic, avoid volatile stocks. Volatility isn't always bad, but it's not for everyone. Match your investments to your comfort level. That's how you avoid emotional mistakes. IPO stands for Initial Public Offering, the first time a company sells shares to the public. It's a company's big debut, letting anyone buy in. Companies use IPOs to raise money for growth, but IPOs are risky. There's hype, little public track record, and prices can swing wildly. Many IPOs drop after the initial excitement fades. Don't get caught up in the frenzy. It's usually smarter to wait 6 months to a year, watch how the company performs, and then decide. For every IPO success, many more fade away. Build wealth steadily, not by chasing hype. Patience is your best friend. Now you know the basics: shares, dividends, market cap, PE ratio, bid-ask spread, liquidity, volatility, and IPOs. Use this vocabulary as a checklist when researching investments. Ask, is this company stable? Does it pay dividends? What's the risk? You're moving from passive saver to active investor. Keep learning, the market changes and so should you. Read, listen, and don't be afraid to ask for help. A good financial advisor can guide you and keep you on track. Every investor started as a beginner. Be proud of taking this first step. Don't be intimidated, be empowered.